This is the tax platform informing the nation on tax matters. We continue with our series on withholding tax, and this week we look at withholding tax on dividends and withholding tax on interest. Now, the reason why we've put this together is that mostly they are charged on the traditional forms of finance, being debt and equity. So if you are investing through equity, you're most likely to earn dividends from that investment. So when you've earned dividends from your investment, your capital or equity, the dividends are subject to withholding tax. Now, the normal rate for withholding tax on dividends is 10%, whether you are a resident or a non-resident. But because with some countries we have what you call a double taxation agreement with, there might be reduced rate for some countries. So you need to know which country you are dealing with, and even the company that you are dealing with, where it comes from, for you to apply the correct rate for dividends when dealing with non-residents. And the rate can go as low as 5%. Now, when it comes to debt, especially when you are dealing with non-residents, you pay the principal and you also pay interest. So when paying the interest should be subject to withholding tax. The default rate is 15% for withholding tax on interest paid to non-residents. But also, depending on which country you are dealing with and that company where it comes from, the rate can go as low as 7.5%. So you need to be aware of your double taxation agreements, which country you have a double taxation agreement with, what's the makeup of the shareholders, and the like. But when it comes to interest also, you can save, have a deposit account, and then earn interest from that. So if you are an individual, a resident individual, you are earning interest from financial institutions, your banks, your savings banks, your building societies, and you are earning interest from that, the withholding tax is at 10% and is a final tax for individuals. But if you are any other person, such as a company, a trust, or anyone else that is not a natural person, then the 10% is an advance tax, and you have to be subject to additional tax on that interest. Also, if you are an individual and you are earning interest, and it is just not from a building society, it is not from a bank, then it is an advance tax, and you'll need to pay additional tax on that interest when you finally file your return at the beginning of, at the end of the tax year. So those are the things that you need to ensure you are aware of. This was the tax platform informing the nation on tax matters. Remember, we are available across all your favorite podcast platforms. Follow us, engage with us on those platforms. Thank you.